If you want to raise some serious capital in today's cautious investment environment, you need to offer your investors a more decent return, and they also need principal protection. In this video, I'm going to break down how to structure a principal protected bond that attracts investors and how adding a zero coupon component can significantly strengthen the principal protection against an issuer default. Hey, it's Frank Nagy. Welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. Today's investors are defensive. After years of volatility, inflation concerns, and credit tightening, many investors are asking, how do I earn a yield without putting my principal at serious risk? That's where the principal protection structured bonds come in, and they're very powerful. Instead of offering a pure equity risk, you're offering investors a defined income with structured downside protection and a clear repayment of principal at maturity. A principal protection bond typically includes 5 core elements: an SPV issuer, which is the bond issued through a special purpose vehicle, isolating the offering from unrelated liabilities; a defined maturity, and that's usually 5 to 7 years. Investors receive 100% principal plus their agreed return. A fixed coupon. You can offer fixed interest, let's say between 8 and 9%. Collateral position. Your principal protected bond would be considered to have a senior secured status since you have pledged assets securing the bond. Hiring experienced hedge fund and capital markets consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your principal protected bond offering. A good consultant will make the appropriate introductions with securities brokers, attorneys, custodians, and paying agents that will help raise capital for your bond offering. One of the strongest ways to protect a principal protected bond is by allocating a portion of the investment capital into a high-grade zero coupon bond. And here's how it works. A zero coupon bond is purchased at a discount and matures at full face value with matching maturities. For example, if you raise $1,000 per investor and purchase a zero coupon bond that will mature in 5 years at $1,000, you may only need to allocate about $750 to $800 depending on the interest rates. That bond accrues to $1,000 at maturity. It creates built-in principal repayment mechanism that exists independently of the issuer's operating performance. Even if the operating strategy underperforms, the zero coupon bond component is designed to mature at the full face principal value, and this dramatically reduces the default risk because the principal repayment is not solely dependent on the business cash flow. The remaining capital will then be deployed into higher yield strategies to generate investor returns. This is how structured products at major institutions often build their products. To make this attractive to serious investors, use a third-party custodian to hold the zero coupon bonds. And this provides transparency, discloses credit quality of the bonds purchased, and of course, structure the offering properly under Regulation D with experienced securities attorneys. A principal protected bond does not mean it's risk-free. There is still credit risk on the zero coupon bond or the assets that are pledged as collateral. And then there's structural risk and liquidity risk. But when structured properly, you shift the primary risk away from the total capital loss. That distinction matters enormously to conservative investors. If you focus on structure, discipline, and transparency, you'll build a long-term investor confidence with your people. Hey, if you would like to learn more about Frank Nagy Financial Services and how we can help you set up and structure your principal protected bond offering or hedge fund or broker-dealer, click on the links in the description box below.